CEO, Chief Economist for ITR Economics, and thank you for joining me for this edition of FedWatch. Jerome Powell was busy earlier this week talking about how the economy was starting off the year strong, and they weren't obviously too thrilled with that, and that it would likely mean that they're going to have stronger rate increases going forward. Sufficiently vague that it could mean actually anything that they want it to mean. The last round of increase was only 25 bips, so what they're probably going to be doing is a 50 basis point increase, or if they go nuts, 75 basis points, both of which are baked into our thinking in terms of the magnitude of the rise. We expect this being March, there could be 2, maybe 3 more rises. As you may recall, the key for us is that they're over with by mid-year. I wanted to show you a chart that we did up here at ITR. We're comparing the money supply, which the Federal Reserve is in control of. It's in deflated dollar terms. It's the thinner, darker blue line on the top, and the lower trend line is the U.S. national debt, and that's a 3-month moving average. So raw data for the money supply, 3-month moving average on the debt. And you can see how persistently that debt has been going up since the early 1980s, and really it's been quite addicting. There's 2 things I want you to see off this chart beyond that. One, see how the money supply goes nearly vertical in 2020? That's the Federal Reserve's response to the pandemic. Their fear that we were going to go into some sort of economic meltdown, and they simply made money appear, the likes of which we had never seen before. And now they're talking about unwinding their balance sheet, tightening monetary policy, quantitative tightening, which includes the higher interest rates. And the question becomes, how long are they going to be keeping the money supply in this negative trend? It matters. It matters because while they are sopping up all the excess has already been spent. So in effect, they're trying to make amends for that Falcon 9 rocket ship going up there earlier. And the longer they keep this trend negative to try and clean up the mess of all that monetary surge, the more this economy is going to have a hard time avoiding recession. It's going to be very difficult for retail sales to continue to go. You can presume that this is not good news for the stock market, because it certainly is not good news for the market. And it's been down and doesn't look like it's going to turn around anytime soon based on where this trend is going. I just thought you should see that their words are about interest rates, but their actions have more to do than just interest rates. It has to do with the cost of money, and therefore banks' eagerness to lend money. It has to do with the money supply and them bringing this down. And it has to do with the erroneous assumptions. They were out there saying how strong the economy was to begin the year. Folks, retail sales adjusted for inflation is going to be the topic of my next Trends Talk. And that is anything but strong. So what concerns us is that they seem to be fighting a battle that they created. They want to blame other people, and they're not even reading the road signs correctly. Beware, it still remains. Are they going to push them up beyond mid-2023? We're going to see a normalized yield curve on the other side of this. The market is helping in terms of long bond going up, but they certainly aren't doing any good right now, they being the Fed. We're still on watch, we're still on Fed watch, and we don't like what we see. Thanks for listening to this edition, and I'll see you next week.